From the hills of West Virginia to the high rises of Chicago. For over 30 years, Dan Frio has mastered the real estate market as one of the country's premier mortgage advisors. Dan is now sharing his experience and knowledge with the AM 560 audience. So sit back and learn how Dan has helped his clients manage the ups and downs of the real estate market across the country. Now, here's the host of the Mortgage Update, Dan Frio.
Top of the morning to ya. So this week, the big news was the Fed. The Fed. They come in and the discussions they have with Trump on Twitter, and Trump's bashing them and everything. But what did they do this week? Well, they dropped the rate that they control, and that's what we're going to talk about in this segment. They dropped the rate that they control. That's the federal funds rate by a quarter. So that's 0.25%. What happens every time when they do this is my phone rings off the hook for about 3 days. And everybody calls me and says, Dan, okay, great. Now my mortgage rate, I'm in the middle of my application or refinance or buying a house. Now my rate's going down at least a quarter, right? Nope. So what I want to talk about in this segment is, what really happens when the Fed cuts rates? Does their rate cut, does that affect mortgages directly? Will that affect your credit cards? What does it do with all the interest rates throughout the economy? So there's a big misconception. What happens is, all rates drop. And that's not the case. That's not what happens when the Federal Reserve reduces rates. What they control is the federal funds rate. Okay? The federal funds rate is the lending between banks when they need to borrow. So what happens at the end of each day, bet you didn't know this, is banks have to have a reserve account. They have to have X amount of money in reserves to cover all of their loans and all their outstanding debts or all the outstanding accounts that they have. Okay? So what they do is, let's say at the end of the day, they need $500 million in assets, but they have $400 million. Well, they go to between bank lending, and they get the money overnight to put in their account. So just think of it. You have a checking account, and tomorrow's payday, but there's some checks clearing tonight. So you're short funds. So you have to go in and borrow funds somehow, some way to cover that until tomorrow you have enough funds. That's what happens. So what the federal funds rate does is it's basically bank-to-bank lending. All right? That's about it. But there is a ripple effect through the market. So what it then does is it affects the prime rate, and it usually correlates 1-to-1. It doesn't have to, but it usually does. So then what does that affect? Well, it makes the cost of doing business cheaper for home equity loans, credit cards, things tied to the prime rate, but it doesn't target, or it isn't specific to mortgage rates. And that's the misconception. So let me read a caption here, and this kind of explains it. It's an article that I just found, and this is the best way for me to explain this to you. So it says, if the Fed cut is perceived to be successful, it sparks economic activity. Businesses may improve, which means that they have additional pricing power. What they do is they drop rates, and that in turn hopefully spurs spending. Okay? But the problem is higher inflation. The bond market may perceive this as bad news for the long term, and mortgage rates could actually go up. So then you say, why is that? Well, the Fed only controls the federal funds rate. So that's a short-term lending from bank to bank. Because of this, mortgage lenders are more concerned with inflation because inflation erodes buying power. So when the Federal Reserve cuts rates, they're trying to spur activity and make borrowing costs cheaper, thus spurring up spending by the consumer. Mortgage rates are kind of tied to other factors, but one big factor is inflation. If inflation rates are going up or if inflation's heating up, then that spooks everybody in the market, so then they drive up mortgage rates. Okay? Mortgage rates are based on what they call mortgage-backed securities, and people buy and sell those kind of like stocks, but they're actually bonds. So what happens is, if inflation is heating up, there is people grab bonds, driving up the price, driving down the yields. Okay, so what kind of gets directly affected when the Fed cuts rates are home equity loans, credit cards, things like that. You might even see car loans or car rates going down. So I wouldn't call my mortgage lender immediately and say, my rate should go down a quarter, because it doesn't. However, many times it does. So that's why I'm trying to show you this, that if you have a rate that you want to just check and see if there's something you can do, call me and we can go over a bunch of scenarios that you might want to look at. Here's what you might want to look at. Consolidating high interest rate credit cards. Because again, if mortgage rates go down, which I'm expecting them to do, they took a spike last week, and this past week, they went down and they kind of came back to historic lows. So take advantage of that. How do you take advantage of it? Well, check and see the rates that you have now. Okay. Check and see the rate you have now on your mortgage. Okay. Also check, what is your credit card rate? You might be surprised when you're sitting there drinking your coffee. Just grab some of your credit card statements and look at the interest rate you're paying. It's absurd how high some of these interest rates are. Don't be surprised if you're in the 20% range. That's crazy. There used to be usury laws when I was a kid of like 13%. Now it's basically indefinite. You could pay whatever the market bears. How it's legal, I don't know. But the lobbyists there have great pull, and they can help there. Here's another thing that most people don't realize. Some of the new tax changes that took effect. If you have a home equity loan that you did not use to repair your home, you didn't fix up your house, you didn't put an addition on, you used it to buy a car, pay tuition bills, pay off credit cards, but did it on a home equity line of credit. That rate is adjustable in most cases. Also, check and see when you took it out, because they're only good for 10 years in most cases. And third of all, they're not tax deductible unless you used it specifically to fix your home. So again, what you might want to do is pull out some of the bills that you have. Pull out your mortgage payment and check on there. So I'm going to give you a little punch list that I want you to go through. And if any of these hit, just one has to hit, give me a call. I'd love to help. So check your mortgage statement. If you've been in your house for 3-4 years, we might want, and you have PMI, meaning you did not put down 20% when you bought the house, or you took an FHA loan out. Let's look at it and see if we can get you out of that PMI. I'm working with a customer right now. It's a high-end home, but their PMI payment per month is $346. We're doing their loan right now. We're getting them a quarter lower in rate, but we're eliminating that PMI. So we're actually taking them, they have 25 years left on their mortgage. We're actually putting them on a 20-year term, keeping their payment the same. Actually, their payment's going down from what they're paying now. So they're shortening their term by 5 years. They got rid of PMI. Their payment goes down. I mean, that's a win-win-win-win-win. So that's a perfect example in what you might want to look at. So do you have PMI? Let's see if we can get you out of that. Is your rate over 4.5%? Let's see if we can bring you down. If you have an FHA loan and the rate's over 4, give me a call. Let's see if we can get that payment down. Check your credit cards. Do you have over $10,000 in credit cards? Are the rates 20, 25, 28%? Let's see what we can do. The next piece of the equation is, are you looking to do home renovations, home repairs? Do you want to finish your basement? Do you need a new roof? Do you need just TLC? Most people during the crash, they did everything they could just to keep their home, but they didn't keep up with the home. So now home values are back. The economy is doing much better. Your job's probably in a better situation. Now you know kind of where you sit. Now you need carpet. My house needs painted. I need new gutters. Don't put it on a credit card, or don't put it on one of those 0% interest tactics that a lot of these companies have, because you only have a certain duration of time to pay that off. But you didn't know this. Let's say you get a 12-month financing and you bought gutters and all this stuff and it came to $20,000. Well, you have 0% financing for a year. Okay. If you don't pay that off in the 12th month, what happens is they divert the interest back to day one. So now it is not a zero interest account. You pay interest back to the day of your purchase. Bet you didn't know that. So that could add on a couple $1,000s in interest that you weren't prepared to pay. So when we come back, I'm going to have a special guest on. It's a realtor friend of mine, Gary Hall. We're going to talk about the big thing going on right now is fix and flip. My wife watches it every night, and it's, these people coming in and they buy this house for $40,000, and then they renovate the whole house for $10,000, which we're going to discuss that because it's so unrealistic. And then, they sell it and make $100,000 and move on. It's not that easy. So I want to explain to you the ups and downs and the pitfalls of buying foreclosures, buying fix-me-uppers, and trying to imitate what the people do on TV. So when we come back, we're going to be with my friend Gary Hall. So don't go away. We'll be right back.
Now, more of the Mortgage Update on AM 560. Here's your host, Dan Frio.
We are back, and like I promised, Gary Hall. We have Gary Hall in here right now. Hey, Gary. He's a realtor friend of mine. So I wanted his input today about foreclosures just hit 1.5 million. And to be honest with you, I thought this was like over. And so what are you seeing out there? Is there still a lot of huge inventory in Illinois that has foreclosures? And then how are we going to tackle that? Let's get some of these people into some of these things.
Well, it's there, and the inventory is being chipped away at. The challenge is for these lenders, these banks. Yeah. They're coming out and they're trying to charge retail prices for foreclosures.
Oh, I know. I had a few.
Greed.
I had a few recently, and they won't budge. I mean, you'll have cracks in the foundation. You'll have this. You'll have that. And they'll come back and say, "Nope, that's what it is." And it's like you're never going to get rid of this house. So what I wanted to talk to you about was there's programs, and we've tried to do a few of these, and we might have done some 203Ks in the past, or we attempted to, and just there's so many pieces of this puzzle that is needed when you're buying a rehab home or a house that needs some TLC that it can fall apart. So what's your thought on? So here's what I get calls a lot. Is they want to get pre-approved for a home, and they're still looking for that I won't say a cheap home, a good priced home that they can go in and rehab. What is your thoughts on the rehab properties versus the ones that are just turnkey, meaning you can walk in and just live in? Is there a huge disparity in price ranges that you're seeing, and just your personal input on it? And is it worth the headaches?
That's where I get into it. Because the banks are getting so greedy, it's almost better to get more of a turnkey property. If you're within $5,000 and you've got $60,000 of headaches, and this other property, this distressed property, needs all this work,
right?
And you think about people don't have the time, and if you don't have the contractors lined up, what's take the path of least resistance? Is to turn the key and let's go.
Sorry, I just threw you in the loop here. You got to tell everybody who you are and what you are. And Gary's a friend of mine. He's been a friend of mine for years now, and we do some transactions together, trying to do more. We've gone back and forth with a lot of clients, a lot of deals, and it was one of the times too when we were going about this was still crash kind of. I'll say the tail end of the crash. It was still hard. Because you still had, going. Yes. Mm-hmm. So now things have somewhat smoothed out. And tell them a little bit about yourself. And then what I want you to do is I'm going to put you on the spot. When you walked in the studio just now, you said, "Man, it's been a weird year." If you can elaborate on that. So, but first, tell them who you are, what you are.
I'm Gary Hall, your Chicagoland realtor with RE/MAX Central, and the car's sitting in the parking garage here with 52,000 miles on it, and it's not even 2 years old. Why? Because the wheels are not spinning. I'm not taking care of my clients.
Cool.
Dan sends
that's
me
like a jingle.
It is. Dan sends me all over the countryside. I've lived in 5 collar counties in Chicagoland and 16 towns. I actively work about 30 different zip codes in Chicagoland. I know your local market. And we really break it down. I'm the kind of realtor, I'll show you 50 homes if we have to. My record is 128. I don't want to go there again, people.
Yeah.
All right. When it comes to listings, I take 6 listings for 6 months. I give you the opportunity to terminate it with a phone call. That's how much faith I have in my marketing. I am an nationally ranked stager. I've got the support personnel. I've got a great inspector, and I've got one of the best lenders here in Chicagoland sitting across from me. So I play to win every day. I don't play to lose.
Cool. So when you first walked in, you said, I said, dude, what's up? And you're like, man, it's just been a weird market.
It has been.
What do you mean?
We've been, listings are requiring a lot more work than they did a few years ago. It's not a total seller's market anymore. Things are equalizing between the buyers and the sellers. And we still have that 16% gap between our buyers and sellers. Buyers and what they feel, their research and their entitlement, and sellers thinking, having the emotional attachment to their home, thinking what they're worth, and they think it's 2005. Well, it's not 2005.
Yeah. What I see is there's pockets, but there's not a huge increase in value. I just had a neighbor sell. Unfortunately, he bought it at the peak, and he sold it for like $200,000 less than he paid. Well, that's not the norm, but
and along those lines, in the next town over from where you live, I just had a friend sell his property for $400,000 less than he paid for it. When you get to those executive level homes, they took the biggest hit, and they just have not fully regenerated. There's still that 35% that came off the top. It's not there yet.
Yeah. So if you're buying, what's your feel on pricing now? Are we high, low? We're kind of
in the middle of the road, especially for your staple three bedroom two bath home throughout your suburbs and in the city of Chicago. It's there. It's pretty stable, but it's not taken off. And there's some places where your prices have come down a little bit.
Got it. We're not trying to scare people from buying homes because
it's just market cycles, and it's this time of year too. Now we're going into the flat time of year. And I'm picking up some new listings, and I'm a brave soul because I'm going to fight to the end. I sell all year long, but my people understand we're not in spring market anymore.
Right. Here's one of the things that Gary and I do. Every listing he has, if you want to check it out, we create a website for every listing that he has. So if you follow us on social media, and I'm actually working on this right now, I'm working with the website developers to have a page where we're going to have all the listings and all the partners and everything on there. So go to windmortgage.com, and within a couple days, we're going to have a partners page, and it'll have all your listings on there. So if you want to reach out to Gary, just go on windmortgage.com. and scroll over. There'll be a partners page, and just scroll down there, and all his listings are going to be on there. We post his open houses, everything to help him kind of help you sell your home. Okay, Gary. So we hear, even with the mortgage stuff, you're listening to the radio today, this afternoon, there's 15 mortgage guys. Why? And I always say, why me? And I explain why Dan Frio, why you want to call or deal with me. Why Gary Hall? You hear these realtors out there saying, I'll list your house, and if it doesn't sell in 30 days, I'll buy it. I'll do this, I'll do that. Why Gary?
Here's why you want to go with Gary. Gary's ranked in the top 3% of the national statistics. And for me, the key thing is I put my skin in the game. Unlike any other realtor, I spend $60,000 a year on the business for the welfare of my clients. I will pay for your general home inspection up to a $700 value. I will pay for a nationally ranked stager to stage your home if you're listing it with me. I pay for professional photography, a virtual tour, and what's the great thing on the web these days? Video. 100% of clients want video. Guess what? Only 15% of us deliver. Gary delivers.
Got it.
So this is where I'm giving you an edge, and the technology's here with support from Dan and his team to give marketing exposure to my listings. I'm very competitive in commission. For full service brokerage, I'm in an office that plays the win. We sell 800 properties a year. This is one family-owned franchise.
Wow.
So my mentors sell 80 to 100 a year, and I'm going for 40 every year. Gotcha. So I take what I do very seriously. So if you want someone with experience, I'm the one to go with. The typical realtor in Chicagoland is going to sell 7 homes in the year. And you have to take people like me in the top 3%. If we pull us out of the equation, they're only closing 3 in a year. I'm not happy unless I have 7 to 10 under contract at any given time.
Yeah, and you have a ton of listings.
I do. So I keep working them.
The listing part of the equation, why are a lot of people using you for listings? And if you would, for my purposes, staging. Dive down that avenue. So first of all, you did talk about why Gary. But the staging part, it's the whole process. We want to, if you walk into a house and it doesn't look right, I always say there's one time for a first impression. So your goal there, my assumption is, you want that first impression impression
right.
to be the best impression possible. So the staging piece, talk about that a little bit.
So with that staging part is so critical. People think, oh, I don't need a stager. And then I look at the pictures on these listings, and you're showing the wrong thing on the web. And then they wonder why their home is sitting, because they did things on the cheap. It's better to have that professional come in. It's going to make that home appealing to 95% of the general public.
Right.
A dear friend of mine walked to me yesterday and says, I keep looking at the pictures, and a lot of them are starting to look the same inside. Is that because of your stager? I said, yes. I said, so tell me, are they yes, they're very, very appealing to you.
I noticed that too.
And I said, well, you see the trend, because my stager's on her game, and she's making the house appealing to everyone.
Right. Most people, they're going to, and I did the same thing. You go on, realtor.com or wherever you're going to go, and you look at the homes. There's many of them out there that's just picture of the front house. I'm probably not going to waste my time. So tell us a little bit about, we'll tell them, the listeners out there, how do they, I'm a proponent of, look me up, Google me. Look me on Google, look me on my reviews, look me up on YouTube, LinkedIn, everything like that. What's the best way that somebody can do their research on you?
Well, ultimately, you want to Google Gary Hall Realtor, Gary Hall, your Chicagoland Realtor, or Gary Hall at Remax Central.
Got it.
And those are 3 avenues right there. The other way, obviously, hit me on my cell phone, 847-651-1993.
We'll be right back with my take on fixing and flipping.
We now return to the Mortgage Update on AM 560. Here's Dan Frio.
Top of the morning to you. We are back. Okay, Gary Hall, he's my in-house expert realtor. So my wife, every night, I just jump on my iPad at this point because it's driving me crazy. She watches these fix and flip houses.
Oh, no.
They'll buy a house.
HGTV. Oh, here we go.
That's exactly what I wanted. Yeah. Okay. Here's my take on it. And I've done this for years, and I've gone to a lot of seminars. I want your take on it because I'm a little bit skewed one way. So, guys, if you're listening out there, this is a caution. Basically, it's woo, 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 an alert. It's not, as glamorous as everybody makes it seem, because I did it, and I lost my butt. You go into and you buy these $30,000 homes. I want your take on that in a second. Then they go, well, let's go that. Are there a lot of those out there in the Chicagoland area that are in neighborhoods that you would want to be in?
Well, they're out there.
Okay.
Ultimately, you get what you pay for in life.
Right.
So if you're paying $30,000 for a house in a market where the median home is running about $235,000, you can do that math, right?
Yeah.
And ultimately, that house is probably going to need $90,000 in rehab or more. And the question is, look at the comps, have your agent pull it up, and see what's there. And you hit on something that's really important. And I have a good friend who used to work in my office who's an expert flipper, and 90% of people out there, they jump into things and they don't do their homework. Yeah. And before you know it, and I'm trying to help sell a flip right now, and my people, they didn't listen to me. They went ahead and did everything on their own, and now they're going to probably take a $20,000 or $30,000 hit. Yeah. And it happens across the board.
That happened to me every time. Maybe I was lucky and I got out, $20,000 in the hole. Mm-hmm. So here's another thing that I see is they go in on the TV show and they buy this $30,000 home in a $200,000 market, and then they'll have their contractor go through, and they go through all this punch list, I call it. Well, we can do that for $50,000. Dude, I did my kitchen. Just my kitchen
for $50,000. Come on now.
And so it's like, how you can't? They can't do it for $50,000. So it's like I don't know if it's completely staged or what. But this is the educational piece of this show.
I can chime in here at a point because for
George,
16
the
years.
Producer.
Hello, gentlemen.
Hit us.
The expectations. Now, I was in HVAC. I wasn't redoing kitchens, but the people's expectations on how much things cost versus how much they actually cost could not be further apart.
Yeah, absolutely.
Right. So, and then as you and I experienced on some of the 2 or 3K loans we had, the contractors.
You've got to get those good FHA approved contractors. And people go in with this expectation, that'll be $10,000, and then they get the bid back and it's $24,000.
Yeah.
And they're going, oh my God.
Right.
Now, just on that project alone, we have 7 other projects on this property.
Yep. And you never know what you're getting into. That was one of the problems I had on like 3 different properties. I got into it, and then I had code violations on this, and then my electrical wasn't standard, and I didn't realize that. So that was another $15,000.
And now the villages the villages are getting more intrusive. They're doing their own inspections, and you got to pull permits for everything.
Got it.
And one thing leads to another. Cliches stand the test of time. Why? Because of the truth.
We're not trying to discourage you. This again, this isn't a mortgage show just to talk about mortgages. I want to educate those. Let's talk real estate. And in the flipping business, is your buddy? Is he full-time flipper?
Yes.
Okay.
In fact, he has a program here on the station.
I wasn't. If you're not full-time, it's not a little part-time gig that you can just get into, whimsy and just hope to God you can make $100,000 and every time you flip something.
Yes.
So
what you're showing on television that happens in Miami doesn't happen so well in Chicagoland.
Exactly. So again, I want to thank Gary for coming in. Gary, you're not going to go, you're not going to go online and give somebody $200,000 of your hard-earned money and hope that they invest it correctly. So don't just use anybody if you're looking to buy a $200,000, $300,000 home. You need a team. The process that we could do is we'll get you pre-approved, and then we're going to set you up with Gary, and he's going to get you out there, and we're counseling you, saying, here's what you're pre-approved for, here's the best program and why. And then Gary's going to meet with you and get you into homes, not sell you on a home, but find your ideal dream home. So again, Gary,
That's
tell.
I take a couple out. I want it to be a 90-10 scenario for you. And until I see both smiling, we're walking away.
Right.
You have to realize the experience level sitting here. The guys sitting here in the studio are not 21 anymore. And we've been around the block and we've done this a few times. I bought my first property in Chicagoland in 1985. Yes, a lot of you weren't even born yet. But
there's a reason why we do radio.
There's a reason why we do radio. Yes, no photographs, please. The mileage is there, but we keep trudging along. And if you work with me and Dan, we're dedicated to this process. And unless you drop the ball as a buyer and don't turn your documents in, we're going to get you to the finish line, and we're going to protect you every step of the way.
Amen, brother. We'll tell them how to get you.
You can reach me at 847-651-1993. The number again is 847-651-1993.
When we come back, we're going to talk about homebuyers.
You're listening to The Mortgage Update on AM 560. Now, here's your host, Dan Frio.
Alrighty now.
That's the music I like to hear.
I want to say a thank you to Gary Hall for coming in today. I want a perspective of a realtor. The show, like I said, our show isn't going to be mortgage. I don't want to do a mortgage show for an hour and bore the bejesus out of you.
No, but that's
if I'm allowed to say that.
You guys were having a very interesting conversation as he was on his way out.
Yeah. So it's really difficult, just to let you know, and then we're going to go on to the bears.
Because you're talking about foreclosures.
Yeah. And again, I'm not trying to talk you out of, if you're an investor and you want to fix and flip in that, God bless you. Give it a whirl. But what I'm trying to do is educate you. I'm not trying to bias one way or another. I'm giving you my perspective on things. I've done it. The realtor is giving you his perspective. It's hard to finance them, because many times the house is $30,000, $40,000. Then you need $30,000, $40,000 in repairs or $50,000 in repairs. Any loan under $100,000 is really tough to get done. Don't ask why. It is what it is.
Which is weird. You'd think there would be a lot less risk in loaning somebody, say, $40,000 or $50,000. As opposed to $300,000.
That's the common sense behind it, and it's
not what the banks.
No, it's actually completely wrong.
Yeah.
The foreclosure rates are much, much, much higher on loans under $100,000 than over $100,000. Believe it or not, because most of the time, what'll happen is if you're in the $100,000 or lower range, you might not have as much discretionary income or as much in reserves. So what happens is, let's say, for example, you hit a little glitch in life. The furnace goes out, the car goes out, the whatever. You don't have that excess reserves or excess revenue to cover those costs. So, that's one of the things behind that. And the renovation loans, they're tough. They're tough in general, unless you get a whole team involved, which I'd love to help you with if that's the route that you want to go. What we want to talk about now is
The Bears.
Big game coming up Monday night. Monday night, they're coming up.
And it's not just a big game for the Bears. It's also a big game for the Redskins, which is who they're playing.
The Redskins.
Yeah.
Are we allowed to say Redskins?
Oh, yeah, this is 8560.
Okay, just wanted to make sure we didn't have to say Washington.
No, Washington is a bad word.
Okay.
But the Redskins is not.
Okay, I wanted to make sure we're politically correct.
Why?
On those. So, I was out of town. I watched the Bears' first game. A snoozer.
The offense didn't show up.
It was a snoozer.
Yeah.
This weekend, I hate to say it, but I had to fly out of town.
I was watching the game as I was at work here.
I was visiting my mother-in-law who had a stroke. God bless her; she's doing okay now. But I wasn't able to watch the game. So what's your take?
Do you have any heart issues?
No.
Then it wouldn't have mattered whether you watched the game. If you have a heart condition, or if you're, what do they give the roller coaster warning? If you're pregnant or you have a heart condition, don't ride this ride. Yeah. It's the same with that game. Of course, the defense showed up. They always showed up.
Yeah.
Offense was comparatively better than the week before, but that really isn't saying much.
I'm glad.
And then
I'll be watching Monday night, though.
They were up by a touchdown with like a minute, I don't know, 2 minutes left, something like that. And you say, okay, they can hold it. And then they gave up a touchdown.
Boy.
But then,
yeah,
the Broncos, they missed the extra point. So the Bears were still up by a point, except they were offsides.
Oh, jeez.
So they then went for 2. They got 2. Now the Broncos were up by 1. We had I think it was 53-yard field goal from the new kid who thankfully didn't doink it. But yeah, they really had no business winning that game after, say the 2-minute warning.
Hey, Bears.
They hit screwed.
I'm just throwing this out there. If you need a kicker.
They don't now.
Well,
kid's got a boot.
My son's a kicker. He played at James Madison University. It's a D1 school.
There you go.
He was the kicker when they won the national championship a couple years ago. He hung up the cleats and now runs a company. But if you need a kicker, call me. Hey, by the way,
had the tryouts. He should have gone out for it.
Yeah, no. I told him. I actually told him. I'm like, dude, you need to go down there. You got nothing to lose.
No.
Hey,
and if you watched any of that, you realize that there were virtually no talented individuals who showed up for it. It was in the snow, and that was terrible. So, okay.
Yeah.
They're playing the Redskins.
You know the line?
I don't know the line, and we're not supposed to talk about it anyway. But
I just wondered who's favored to win.
I don't know, but I will give it a 50-50.
Okay.
And first our predictions, Ditka 175.
Ditka. You got to say it.
Ditka
500.
Ditka.
The Redskins 0.
But the Redskins offense is terrible. So they've lost squeakers to the Cowboys and the Eagles. Now that's deceptive, right? Because the Redskins really played up to their opponents in those games. But if the Bears defense shows up, the Bears have a very good chance of winning this game because the Redskins defense is atrocious.
It is almost a dead heat in the who's supposed to win this thing.
Yeah, and if you would have looked, say, 3 weeks ago at the predictions for that game, the Bears probably would have been listed as a blowout.
Yeah.
Right?
I was on that bandwagon.
And the offense has performed so terribly over the last couple of weeks that it's easy to see why people don't have a lot of faith in it.
Yeah, I got you. Hey, by the way, before I forget, we have an 800 number now.
Yes, you do. It's 833 Dan Frio.
Ooh, so if you like what we're doing, if you don't like what we're doing, or you want us to add some segments on the show, or what we can talk about, please give us a call.
We're setting it up right now. Actually, as we speak, it's being set up. People want to comment or have a question on something we've covered, or they want us to cover something that we haven't covered. Whatever it is, you want to just yell at us, you want to just call up and say the Bears, that's fine. Whatever you want. And it's 833 Dan Frio.
DANFRIO.
That's right.
When we come back, like every other show, we're going to end up with a credit hack. So don't go away.
This is the Mortgage Update on AM 560. Once again, here's your host, Dan Frio.
And welcome back. Right now, we want to talk, at the end of each show, I'm going to try my best, depending on the content we have at the beginning, and hopefully we get to this, is credit hacks. Now, what do I mean by a credit hack? Basically, what I'm trying to do is just educate you on credit stuff to help your credit scores, your credit ratings, everything else, because credit is such a big piece of your life. So I actually created, and this isn't a promo for this, but if you would go to creditscores.com, plural, creditscoresandmore.com. This is a website I actually created. Go there and use it. Most of the stuff is absolutely free. Step one is what I want you to do. Okay. Everybody and anybody, just go to step one. It's completely free. It doesn't ask you for your credit card. Doesn't ask you for anything. It'll give you a credit score. It'll give you credit monitoring. It'll give you identity theft protection up to $50,000. It'll give you blogs. It'll give you content. It'll give you educational tutorials. It'll give you the most likely credit card you'd be approved for. It gives you a ton of stuff for free. I didn't create it to get rich. If and when it asks you to buy something or, upgrade your services, don't do it. That's it. Now, the credit hack of the day. You might hear what they call utilization rates or utilization percentages. So here's what I want you to do. When you look at your credit from whatever system you use, and hopefully you go to creditscoresandmore.com and do step one, go through that and look at your credit score and look at your accounts. Here's what I want you to do. Look at your high credit limit versus the amount you owe. I see this a lot, and probably too much, is when you're hard pressed to get a credit account or credit card, you went in and took whatever they gave you. So, for example, you got a $500 line of credit on your credit card. Okay, you went to Costco this weekend and you spent $300. Okay, $300. $300 of a $500 credit limit is 60%. To get the highest score possible, you need to be under a 30% utilization rate. So 30% of your high credit limit. So what I'm asking you to do, I'm not asking you to pay down your credit card. What I'm asking you to do is call that credit vendor and ask for an increase in your credit line. So let's say, for example, in this case, you have a $500 credit limit, high credit limit, and you use $300. Call them up and say, could you increase my line to 1,000? If they do, now you went from a 60% utilization, which is 300 divided by 500. You use 300, you had a $500 line. Now you went to 30. So you owe 300 on a $1,000 line. So what you're going to ask is, okay, great. Well, that'll increase my credit. However, they had to pull my credit to approve the increase. So that's going to be a hard hit on my credit report. Thus, it's going to reduce my credit scores. Yep. Let's look at the numbers. What's going to happen in most cases? You're going to get hit, let's say, 6 to 10 points for that credit pool. Okay, so we're at a -6. However, now your utilization rate went from 60 to 30. You might pick up 30, 40, 50 points. So let's go in the middle and say 40. So you have a plus 40. So the credit pool cost you 6 points. The utilization rate increase added 40. You still net a plus 34 to your credit scores. You didn't do anything other than make a phone call and ask for your credit to be increased.
And then 90 days out, that hard hit, that hard inquiry goes away.
Pretty much irrelevant. Exactly. So again, I want to thank you so much for listening to the Mortgage Update with Dan Frio. I, of course, am Dan Frio. If you'd like to reach us, we have a new number now. It is 833-DAN-FRIO. And how you spell my name is DANFRIO. I want to say God bless to you. Go Bears on Monday night. Take care. Have a great week.
You've been listening to The Mortgage Update with Dan Frio. For over 30 years, Dan Frio has mastered the real estate market as one of the country's premier mortgage advisors. Call Dan today at 844-775-LOAN. That's 844-775-5626. Or online at thefrioteam.com.